You're listening to Real Investor Radio with Craig Fuhr and Jack Bevere, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. All right, everybody, welcome back to Real Estate Investor Radio. I'm Craig Fuhr, back with Jack Bevere and Fred Lewis of the Dominion Group here in Baltimore. And we're also here today with Dennis Cisterna. Dennis owns a company with Fred called Sentinel Lease. They're a real estate investment firm founded in 2019 that focuses on acquiring commercial real estate investments that either produce monthly cash flow or that possess profit potential via value add. And so we're kind of shifting our focus right now to talk more about commercial real estate and what Fred and Dennis are seeing in the market, including Jack as well. And I think we all feel that there's a shift that has happened. It sounds like you've been really beating the bushes for several months to find decent commercial deals to get into, but that's been proving to be a bigger needle in a haystack than you would like. Sounds like you've been a little bored over the last several months, but you might be seeing a shift.
Well, I don't know if bored is the right word. Frustrated is probably
frustrated
better.
is probably the better word. Yes, exactly.
But sometimes when you get frustrated too long, you just kind of give up and then you get bored. No, it's been really an interesting market to follow.
Why don't you do a better job of telling people about Sentinel Lease than I just did?
Oh, sure.
How you got into the business?
Well, I think you read the copy from the website excellently, Craig, so I don't know what you're talking about.
Thanks for noticing.
I wrote it. It's easy. In any case, it's pretty simple. Fred and I started Sentinel Lease in late 2019. We originally were looking at some smaller investments to put out capital for actually a family trust. Kind of a little bit backstory here, and I have a long history in acquisitions in not only build for rent and SFR, but also in commercial real estate as well. I've really worn a number of hats throughout my career, so he asked me to assist him. So we started looking at a bunch of retail, industrial, office assets, and we were looking kind of in the $3 to $5 million range, and I wasn't really seeing anything that I thought was particularly compelling. But I noticed if we go kind of one level up to let's call it $7 million to $20 million, which is essentially kind of the middle market of commercial real estate, there was a lot of interesting opportunities. There was not the same type of pricing consistency you were seeing at this lower level. And what we realized was a lot of the smaller opportunities were really, the prices were governed by 1031 buyers, right? So people that were in need of buying a new asset to replace their old one. And so the pricing for a lot of those assets was highly commoditized. We were looking at Starbucks and Taco Bell's and Walgreens, and they all traded within a very tight price band, regardless of the location, which I thought was very interesting. And then when we went one level up, we started to see some really interesting opportunities there where the pricing was not really tied to the risk in a lot of scenarios. Brokers didn't really understand what an asset should be priced to relative to the risk. So a property could be in a great location or a bad location, have a great tenant, a bad tenant. There was no real consistency where you could see anything on a sliding scale. It was just kind of all over the place. And a lot of that is because that middle market doesn't have the same depth of investors that the small market does, or that the larger institutional do. So, 25 years ago, $7 to $20 million would have been an institutional size deal. But as private equity and hedge funds have gotten larger, those are small deals. So now it's middle market. So it's kind of most of that market is comprised of syndicators, family offices, non-institutional investors. So there's a lot less of us. So the pricing is not nearly consistent. So we saw some interesting arbitrage opportunities. We tied up our first deal, which was an Amazon customer service center in Huntington, West Virginia. I did not know much about Huntington, West Virginia, other than it was known for Marshall University and methamphetamines. But we loved. Sorry to the folks at Huntington. I now have learned to love that town as I visited it with Fred. But it was an interesting opportunity. It was something that we were not gung ho at first, but we started to understand the narrative around it. And I think that's what we've learned in our business at Sentinel Net Lease is the deep dive that some desktop analyst jockey is not going to understand sitting at a desk in New York or LA. We go into the towns where we're looking at considering assets. We meet with the mayor, we meet with the economic development department, and we understand what drives that piece of real estate. We understand what drives that tenant, and what that narrative is around why it's important to that community, that tenant, whoever. And that helps us understand and price appropriately. And it's allowed us to grow the portfolio from that initial Amazon deal of almost $17 million to nearly $300 million in assets in, a little over 3 years. And we did this, we closed on Amazon in right when COVID was going underway. When the country shut down was when we closed on Amazon. And so we're raising capital for our first deal. We had, and literally they are shutting down basketball games and the golf tournaments and everything else. And we're going, whoa. Well, if there's one company that's probably going to survive and through all this, it's the company that's delivering stuff to everybody if no one can go outside. So we should probably close on this deal. Literally about 25% of our investors walked away just because they were spooked overall. We walked a lot of them back in and said, look, what other company is going to thrive in this environment better than Amazon? It worked out well. And over, the next 3 years, we were able to create a very strong reputation as someone that can do exactly what we say we're going to do. It's tough for syndicators. And we bought what we thought were, very, we took a very thoughtful approach to the assets we acquired. We acquired a number of essential services, tech forward, mission critical real estate. So customer service centers, corporate headquarters, grocery stores, all that produced extremely strong cash on cash return from day one, and that we used highly accretive debt on. So we've been, pretty fortunate to grow the portfolio over that period of time. And do something that a lot of other investors weren't doing. We were creating our equity the day we bought it.
I have to stop you. Jack, what are you smiling
about? What are you smirking at, Jack?
I'm smiling because I remember Fred pitching me on, hey, I'm talking to Dennis, and it's late 2019. He's like, hey, I think we're going to start doing this net lease stuff. Like, do you want to be involved? And I'm like, net lease business? Like, isn't that buying like a 7 cap and then levering it with 5.5% debt, so you can get a levered 12? Nah, I'm cool. Thanks. And then you guys do this Amazon deal and in the midst of COVID, and then post COVID, you're off to the races, and all of a sudden the 7 cap became a 10 cap and the 5.5% debt became a fucking 4. So all of a sudden, these levered 12s
in most cases, but it's okay.
Yeah. By the way, a levered 12 is phenomenal. If you're actually buying at a 7 and borrowing at 5.5, you're getting a levered 8 and a quarter.
Yeah, exactly. And so all of a sudden, Fred's showing me these deals so I passed, right? I'm like, nah, go have fun with Dennis. And then you guys start bringing in these levered 20 pluses every 45 days, and I'm like, shit, what do you guys what do you guys up to? Hey, send me the next one. Can I throw in on that one, please?
I think we got Jack in a few of these deals, right?
We did.
Yeah, but yeah, you're very great, very gracious, and let me jump in the coattails that I had passed on.
Well, trust me, we wish you were involved earlier because you're a great operator and a smart guy. But we'll gladly take your money anytime you want to give it. Craig, I think that the easiest thing to help the investors understand kind of our investment strategy is, think of it as, if you look at the traditional investment model of core investing, value add, or opportunistic, most of what we're buying are core assets. So usually Class A, office, industrial, retail, but they're going to be in primary or secondary markets, and they may not have the same type of term, which is usually 15 years plus for most core investors. We'll take on deals that have as at least historically, we'll have taken on deals that maybe have even only 2 or 3 years of lease term left if we understand the asset good enough. And an example of that, go ahead, Jack.
And then the opportunity that comes from that is that, frankly, because of the price point, which is neither 1031 small investor commercial real estate, nor is it 50 million plus institutional real estate, you've got this so there's this middle market that is less institutional, and a lease term or some other situation with like a distressed seller or a motivated seller, or there's some story behind, there's some narrative behind the opportunity that has enabled you guys in this, as you mentioned, like less liquid market to find what you think is, a couple extra 100 basis points of unlevered return, and then you go put great debt on it, and you're finding good deals.
Right. That's right. And so
in theory,
we've done it a few times. Obviously, it depends on how the exit works out. Having interest rates at 7% plus doesn't help anybody right now. But for most of our deal,
kind of the transition I was hoping to make.
Yeah, well, look, I think one of the benefits we have, because we syndicate all of our deals on a 1-by-1 basis, we're not set up in a fund environment where there's an investment horizon or an expiration date that we're fighting against. We don't have a gun to our head to make a bad investment decision when it comes to a disposition. So we buy these assets thinking about, it's great if we sell in 3 years. It's great if we sell in 5 years. It's great if we sell in 8 years. It produces a strong enough cash on cash return. It's going to beat the heck out of any other fixed income property you're going to go look for. From a risk comparison, the credit is typically secured by, high credit rated or even investment grade companies. So you look at what their corporate bonds trade out versus what this clips a coupon at, and they're not apples to apples. This is not as liquid as a corporate bond, but it helps to look at a comparison from the risk standpoint, because the default rate is very low for an investment grade tenant. But we're looking at all these things, and we're kind of saying, okay, look, we have a primary scenario, and if it does this, we think we can generate a return of a certain number. But if we hold on to it a little earlier, we sell a little, or we hold on to it a little later, we sell a little earlier, that's fine too. We're going to make the smartest investment decision that at the time that it makes the most sense. So right now, we're not a seller of assets, because why would we be? We don't have to sell. We've secured everything with long-term debt. And now we're taking advantage of the changes that have occurred in the market. So whereas 2 years ago, if I could buy a deal at an 8 cap and it has 8 or 9 years of lease term left, and I can borrow at 3.5, well, that's going to produce a low teens cash on cash for our investors. They're going to get the majority, if not all, of their capital back just from contractual lease income. Great. Maybe that deal's only 5 or 6 years of terms back then. Now, because of the shift in interest rates, we're not looking at a single deal under a 9 cap. Before, our minimum threshold was a 7. So even though interest rates have gone up 300 plus basis points, our shift on cap rates has moved up only 200 basis points, but our duration has gone from a minimum of 2 or 3 years up to nothing less than 7.5. Right.
So that's nothing less than 7.5 years left on the lease.
That's right.
Yes.
Right.
Because we need to make sure that if not 100%, 90%, 80% of the capital during the contractual lease term goes back in distributions to the investors. That is the thesis we're working under now, given the market.
So one of the things that we were talking about prior to pressing record today was that you've sensed a shift. Obviously we've had a disconnect between interest rates and asking prices on assets. So you're sensing a shift recently. You want to talk about that?
Yeah, I think you have seen, and this is not everybody, because trust me, I could screen share here and show you hundreds of deals that make no frickin' sense to anybody. I don't even think the brokers want to post them at this price, but if they want to take the listing and they got to retain their relationship with the seller, there's some pretty laughable listings still out there right now that have been out there for some time, and those don't get any traction, and eventually they go away. But I have seen in the past 30 days a pretty significant increase in the baseline ask from sellers on what I would consider to be pretty high quality assets with decent duration left. So, um, as an example, before 30 days ago, I was seeing a lot of office properties kind of in the mid 7 cap range. I was seeing a lot of industrial in the fives. I was still seeing some multifamily in the fours. I still see some multifamily in the fours. I don't really want to talk about that, but good for those cash buyers, I guess, Jack. Anyway, so now I've seen I've literally seen in the span of the last 30 days, I've seen almost like the baseline ask move up about 100 basis points, if not more. No, and those brokers are knowing they're not going to get a bid at full ask, right? So you're looking at a 100 to a 200 basis point swing in terms of what some of these sellers are expecting. And that's made it a lot easier to have real conversations and dig into assets now. I will tell you, from May of 2022 until a month ago, it was plodding along, as you said, Craig, needle in a haystack type of stuff. And we are, we thrive on situational opportunities. We did that even when the market was good, but even those markets seemed to go away. Even that market kind of went away for a little bit, or it was harder to locate some of those deals. And as I said, we don't buy anything using negative leverage, so it was just tough sledding for a long time. We only bought 2 assets over more than a year period, and before that, we were typically buying 6, 7, 8 assets a year. You don't go to.
You said that's after looking at hundreds and hundreds of deals, correct?
Yeah, we look at about 200 deals a week. 200 deals a week, and I don't mean like we get an email. We get an email on about 1,000 deals a week. Of those, about 200 get an actual review of some type. And we put out, maybe on a good month over the last year, we put out maybe 2 or 3 offers a month. And that's probably being aggressive. Now
that's something that I've always liked about the Sentinel deals, is that since I know the way you guys raise capital is not to have raised a fund that you have pressure to then deploy, but instead you're raising money on a deal by deal basis. When I get a Sentinel email about the latest deal, I'm like, ooh, Dennis and Fred found something. Like this must be interesting. Like, because
that's how we feel too, Jack. Trust me, because it's pretty freaking boring if you can't find anything that pencils.
Yeah.
We appreciate that.
No, I think it's a tremendous money, effort in this market to kind of find value, and whether you have a fund, whether you don't have a fund, whether you do a syndication one at a time is what investors have to think about. Whether doesn't matter what the asset class is, multifamily, office, retail, industrial. It's how you want to raise money. We've taken the approach that not only is it our money that we're investing, but as we syndicate our friends and family capital, we'd rather lose our money than lose their money. If you're guided by that principle, that it's more important that you don't lose a penny of anyone's money that you raise, I think it makes it's more discriminating and harder, because you want to make sure you return, that you return their capital.
So let me ask about that. So like, given that you guys are still reviewing office assets and have office assets in the portfolio, and the future of office usage in America, frankly, is like got a tremendous amount of still uncertainty around it. Interest rate environment aside, just there's questions about like the fundamentals of the asset class. How are you guys thinking about downside risk protection in that regard?
So I think it's important to note that we don't just buy generic office, right? We don't buy a random building chock full of 40 tenants that, has a law firm and an architecture firm, whatever. We're generally buying mission critical real estate to a firm. So as an example, our latest acquisition, which we actually close on next week, it's an insurance company's headquarters in Davenport, Iowa. I'm sure nobody listening knows where Davenport, Iowa is, or maybe a small population does, but it's in the Quad
All right,
Cities area.
so just to be clear, guys, we've already lost Hawthorne, West Virginia, and Davenport, Iowa as our listenership. So
It's Huntington, West Virginia, and I'm bringing them back. No, at Davenport, I will tell you, much as I was pleasantly surprised when I went to Huntington, West Virginia, and a number of other places we own assets, I was pleasantly surprised when I went to Davenport. So Davenport is part of the Quad Cities metro area. It's on the state border of Iowa and Illinois, a couple hours west of Chicago. This insurance company is a wholly owned subsidiary of a much larger Fortune 500 insurance company. They've been in this area for almost a century. They were in their last building, which was on a landlocked side of town, of another town in the Quad Cities, for 30 plus years. Old, decrepit building. This was a build to suit for them. They love it. They have every desk full and occupied here. And so they have great utility in the building. And so we like the narrative around it.
Can I just
so they're not working from home?
That's the incremental test now. Dennis flies in and literally says, "Are you sitting at your desk, or are you an actor? You came in, for the meeting."
Yeah, we have a pro forma on who shows up to work.
That's right.
Yeah, man, I'm so intrigued by the amount of due diligence that has to go into something like that. Like, at what point do you get on a plane, go out there, really, start looking at all of these factors that go into, putting the deal together?
So we do a lot of, this is probably unique. The commercial real estate acquisition process is a lot more detailed than fix and flip buying. Or maybe even single family rental, because the amount of variables is so much greater. Not that doing residential investing is hard, but I can assure you some of the quantifying some of the risk around commercial real estate investing is tough. So we are already doing, desktop review and analysis before we even submit an offer, right? So we have a good understanding on where the property is positioned rent wise relative to the market. At what discount are we buying to replacement cost? That's also a sticking point of pretty much every asset we acquire. And understanding what our projected return of capital is from contractual income, as Fred mentioned earlier. So in this deal, I think it's like, 80% or something is contractual income coming back. So, not only do we want to create profit, but we also want to make sure on the downside we're minimizing any potential loss by any means necessary. And then as soon as we have the property tied up, I am on a plane somewhere, or Fred is driving somewhere if it's in the Northeast. I'm not gonna fly across the country just to have Fred to drive 45 minutes. But we're boots on the ground, meeting with the stakeholders of the property. So, your existing property owner, the tenant, municipal and elected officials, to understand really how does this fit into that market. Why is this building important? How sticky is the likelihood of this tenant sticking around here, and everything else. So
can I ask you something?
It's fun. Sure.
It is. I mean, it must be tremendously interesting and fun. But when I've met with municipal officials before, planners, mayors, city council members, Fred and Jack have certainly had more than their fair share of that too. They tell you get the truth, and then you get the rosy truth, and you get the, we're pretty sure this is going to be in part of the master plan and stuff like that. And so, how do you discern from the bullshit to what's real?
Well, I think what you guys are generally talking about is talking to elected officials as it relates to proposed developments and potential developments. It's a totally different type of conversation when you're talking about something that's already part of that community.
Right.
So when we talked to the mayor of Huntington, West Virginia about our Amazon asset, he gave us this great background story that you would never get anywhere else, which was, well, you see here.
Just give you the picture. He was in a tweed brown suit with a button-down vest underneath it, with a little
elbow
hat
patches and elbow patches.
And he had a feather. He had a feather in his hat as he sat there to talk to us about. It was perfect. Yeah,
it was
76 Cadillac DeVille.
Yeah, I didn't get to see what vehicle he pulled up in, but I will tell you, it's a conversation you're not going to get unless you go ask for it. And so he gave us this great background story of the reason that Amazon is in Huntington, West Virginia, is because one of Amazon's head real estate guy married a girl from Huntington, and the girl from Huntington was back in town visiting with some people, and the pastor was there, and a pastor from the church explained how great it would be for the community if Amazon, and swear to God, they put everything together. Marshall University was now part of the pitch, in that we will train people to work at your customer service center here. You have a great feeder. We already have a lot of customer service centers in Huntington. We're the perfect market for, and so Huntington sold Amazon on why they should be there. Now they've been there for 20 plus years, and as the mayor said to us, Amazon is an anchor employer here, in that other big companies want to come to Huntington because Amazon is here. And so they said, if these guys are ever going to leave, I'm going to call the governor and we're going to put together a tax incentive package to make sure they never go. And Fred and I heard that and said, okay, this sounds pretty good to us.
What's for lunch?
So shifting back to kind of the overall market and what you've been seeing when you're talking to brokers, how, you've mentioned that you felt like that there's more capitulation, right, on the seller side, and that deals are coming out even from brokers and through brokers at a higher cap rate, that may even make sense or comes close to making sense from the get-go. Can you is there color behind that, or is it just a trend that you've noticed? What's the why?
This goes back to the excellent commentary we had on episode 12, where we talked about people are realizing that interest rates are not going back down tomorrow. And that includes these sellers that obviously, for the most part, have been institutional or quasi-institutional owners of real estate. They realize that if interest rates aren't going down in the next couple of years, and I have a lease that's burning off, right? That lease term is getting shorter over time. I probably am not going to get a better value on this property in 2 years unless something dramatic happens. So I might as well sell now and then hold on to that capital and maybe buy something else later. So you have sellers starting to understand that, hey, I might be at peak value right now, even though interest rates are high, because the industrial retail office market is a little different from multifamily and SFR, in that we calculate the lease term as a part of the way to derive value. So the longer the lease term, the lower the cap rate. Now, unfortunately for the sellers right now, the interest rates are 6.5% to 7% for office, industrial, and retail. Maybe a little lower than that if you find the right bank, but so they're going to have to sell at a spread that's positive to that, because they know there are no buyers out there buying with negative leverage on these type of assets. Save a little bit, save for multifamily, which has some cash buyers and some other speculative guys, because they're also kind of long on housing, as we talked about with SFR, Jack. And then a little bit on industrial, because guys are making a macro bet on the way that logistics are going to continue to grow in the United States over the next several decades.
So you got sellers thinking that they're selling at peak value, and you guys think that they're not selling at peak value, right? Because otherwise you'd be making a shitty buy. or really it's that they just, they realize that, hey, given that we've got 8 years of duration left in this lease, if I wait 2, I've actually materially impaired, and they're just not willing to wait to the renewal.
Peak value relative to whatever their investment horizon is. And this goes back to the same principle of most of these institutional owners are set in some type of finite timeline where they have to sell these assets.
There's a wind down.
Even if there's an extension option beyond the wind down, that maybe they've got another 36 months. And obviously we're not talking about the entire universe of commercial real estate. We're just it doesn't have to be. It just has to be a small percentage that will truly mark to market. And now, Fred and I are off to the races looking at deals that we think we're fine holding on for. If we hold on to them for 10 years and they produce a 12, a 13, a 14% cash on cash return, that's a pretty good situation for an investor that's looking for some type of passive income. Certainly not a bad place for us to put our money.
So the deals that have you mentioned that you're looking at these longer duration deals now because that's an offsetting factor to the other, kind of undercurrents. So, for the commercial real estate owners that have a tenant in place and it's got 6 years or less of duration, are they just along for the ride? They're just going to hold this thing till renewal?
Or do you see them putting them out at prices that are there's two options. They're I guess 3. Either they're not in the market, or they're pricing it to sell, or they're not pricing it to sell because they're delusional, in which case it won't move at all. But I mean,
what's pricing it to sell though? With 4 years left on a tenant, what's pricing it to sell?
12-13% cap rate.
Wow.
But who wants to take that risk in this environment? Depending on and by the way, that's on office, right? So if we're talking on retail, that might be an 8 or maybe an 8.5. On industrial, it might be 7.5. And then it goes back to
retail.
Yeah, we own 3 grocery stores, a BJ's Wholesale Club, a Tesla dealership. If you want to consider that retail, it's really more specialty use. But we look at a lot of retail. But again, because we're very focused on having highly accretive debt, I don't consider 100 basis points between my cap rate and my cost of debt to be, very accretive. I'm looking for 200 basis points plus, preferably 300 basis points. So we're looking. So it's not quite there for us yet.
So what are the so shifting gears slightly? So what's the debt situation? You go to buy this asset, and how has it changed what's the past 12 months? Give me the narrative of what the debt situation was 12 months ago and walk me forward to today.
Can I just show an arrow? Can I show an arrow going down? That's how you could quantify it. So
is it still there though? Is it still going down, but there?
Yeah, debt is there, but it's there for well-qualified borrowers. The leverage amount is less. Obviously, the cost is much higher. I'll give you a snapshot of what our last loan looked like before interest rates went up to what it would look like today. So, I would say our last pure deal was that we closed on in March of 2022. 10-year fixed rate debt, 3.5%, 70% loan to value, 3 years old, interest only, and then amortizes over 30. And we paid I think that was a 1 point origination fee because it was with a credit union. Almost everything else is 50 bips.
It was an 8 cap.
And that was on an 8 cap deal. With a Fortune 50 company and investment grade credit. So that was then. Now I would tell you, other than a handful of groups who are still kind of aggressive on the leverage standpoint, we are looking at 55% loan to value.
Loan to value or loan to cost?
Loan to cost. I mean, sorry, yeah, cost. Oh,
same difference.
By the way, there's a whole nother nightmarish issue as it comes to appraisals now, because every appraisal firm is in cover your ass mode. So they
Always
are
fun.
they are looking for every method possible to devalue the property, whether or not, and we've already gone into this on a couple deals where it's very clear they're that the lender is trying to steer the appraiser. So 55% loan to cost, almost exclusively 5-year term, maybe 1 year of IO, maybe 2. Non-recourse, I feel like the amount of non-recourse lenders has been cut in half, if not more. Now they're looking for at least some partial recourse. There's some out there. Fred and I have a bunch of great banking relationships, which has helped us, but it is tougher sledding for sure.
Like
what is
beyond
partial recourse, by the way?
beyond bad boys and completion guarantees.
Yeah, so maybe so our guarantee will be, let's say it's a $5 million loan. They want us to cover the first $1 million of losses.
Mm-hmm.
Which we don't, because we syndicate our equity. That doesn't make sense for Fred and us to do, and I to do. We're going to put in 10% of the money, but we're going to take 100% of the risk. That doesn't make sense for any investor. But by the way, the way we look at this, it's really simple, because I when I go to panels or conferences and I speak on panels, and I'm up there with a multifamily guy or someone else, and I have them walk through their business plan, and their business plan generally revolves around when interest rates get lower. Cool. Great. If they don't, what happens? Okay, they earn a very, very, very poor cash on cash return, and then ultimately have to sell, probably not making any money upon the disposition. Our investment thesis is pretty simple. I am going to double or possibly triple your cash on cash return. And then if interest rates come down, I benefit, Sentinel benefits in the same way you do. Now, our cap rates aren't going down from 9.5% to 5%, but they don't have to. They just need to go down 100 basis points, 150 basis points, the same way you're underwriting, even less, for us to still outperform the potential IRR, because we are already deriving between 10 to 15% or more per year in income from the property. And that's really the biggest delta here. If you're going to if your investment thesis involves the speculative bet of interest rate decreases, we are going to beat the shit out of your strategy every time, because of how much in-place income we already have. I've silenced the crowd. I appreciate that. That's what I always.
Yeah, which is right now, given the lower leverage that Dennis was mentioning, which is why duration now really matters, and we have to have that spread on a higher cost of funds. So to find deals, you got to find 9 caps. I mean, Dennis will send me. He'll go, as he said, he'll go through 150 deals. He'll send me 5 to look at.
There's still an underlying bet that there is positive terminal value, right? Like, yes. That's still that is part of your thesis here, is that, like, these are not going to be worthless, and 8 years from now there's going to be a tenant, and we're not buying C-class stuff that's going to be completely obsolete. We're buying A's and B's that are still going to be that are still going to be desirable. And hey, we're probably not going to build any office for the next several years. So that's going to be the inventory in a growing American economy.
Well, I think that's a really good point, Jack, because that is the conventional wisdom on office is nobody's ever going back into the office again. But if you really look at the data and you look at what you're hearing from the executives of Fortune 500 companies, they are pushing as fast as they can to get people back into the office at least 3 to 4 days a week. They'd love more if they can get it, but right now we're in such a employee friendly labor market because we have a shortage. Let's face it, right? We have all of the baby boomers exiting the workforce and not enough people to replace them in a growing economy, which has been a big challenge. So the employer has not had as much leverage as they've wanted over this, but you can see the writing on the wall. It does not mean that we're going to go back to what normal office utility was before 2020. We don't think that, and we're obviously bullish on office to a degree. We also look at suburban office as a completely different universe than downtown central business district offices. We don't want to get we don't invest in downtown areas right now. We're firmly convinced these doom loops that are occurring in these areas where nobody's in the office, nobody's using the restaurants, nobody's using the retail. That's a problem for the foreseeable future. Doesn't mean the end of all downtowns. That's a little silly. But what you have seen is a revitalization of the suburbs in a way that they have the amenities, commercial services, restaurants that just were never there before. It's no longer just a sea of Bed Bath and Beyond and Chili's and Applebee's and Chick-fil-A. It's like these suburbs have some pretty hopping spots now all throughout the country because they understand that people want high quality attractions and amenities close to them. So that helps it. That helps from that perspective. And then in addition to your point on the supply side, we are buying Class A properties that were built within the last 20 years. One of our recent acquisitions was called Bannockburn Corporate Center in Bannockburn, Illinois. This is one of the nicest suburbs in the greater Chicago area. The average median income is $250,000. We acquired the building for $126 a square foot. It would cost $550 to build today per square foot.
And it had the lowest tax rate as a municipality in the region.
Right. There's a lot of the nuances of diligence, right? So you look at Chicago as a metro area is kind of losing population, but it's still the third biggest economy in the United States. So yes, it's losing population, but it's still much more dense than a lot of these growing areas that you're talking about are. And so then we look for some of the positives, right? Because the entire metro area is not painted the exact same way. So we look, okay, let's look at where the population's actually growing. That's in the North Shore area where we're at. Let's look at where the Fortune 500 companies are. That's where we're at. So we're looking at some of the quantitative and qualitative data to help inform on these micro locations within the larger metro areas, even if the metro area doesn't necessarily point positive. But so then we have these Class A buildings that are at a fraction of replacement cost. That's a defensive barrier against new construction as it is, right? We've got a nice building, but we have it at 20 to 30% of replacement cost. We know people aren't building new office right now in a lot of these markets as it is, because obviously it doesn't make sense. And we know that a lot of the older Class C 70s, 80s, even 90s era stuff is going away. In a lot of markets, it's being knocked down or repurposed for residential. And even for groups that do want to stay in and have their workforce in the office, they're not moving into those older buildings. They're moving into nicer ones like we have. So because there's still affordability there. And that gives us a lot of flexibility in that we could lower our rents by 20 or 30% in a lot of our buildings and still produce a substantial cash on cash return. We don't need to, but acquiring at that lower basis gives us a lot of flexibility to navigate, a very spongy market.
So speaking,
go ahead, Greg. No, go ahead.
I was going to say, this morass and frustration that you've been in since May of last year, it's sort of up until a month ago. What are you excited about over the next several months? Given the headwinds that we obviously have that don't appear to be going away with interest rates and things like that.
Yeah, I think I'm just more excited that there are market participants on both sides that are ready to transact. Mm-hmm. I think that the last 12, 13, 14 months have helped stabilize a clearer picture of what is going to actually happen with the Fed. And I think, Fred alluded to that on the last episode, that's why you've now seen the 10-year Treasury, increase further. Like, people have an idea that this is not going to be a roller coaster of interest rates. Like, we are climbing, and we still may climb a little more. And then we're going to be riding steady for quite some time until the market experiences some pain that's going to cause, rates to come back down. So I think it's us buying under this new paradigm, knowing we can still generate an above average cash on cash return, and then ultimately take advantage of any cap rate compression that occurs if it occurs. If it doesn't occur, that's okay. If it doesn't occur, we're gonna outperform the cash on cash return of other real estate assets. And if it does, we think we're going to be able to produce a value add or opportunistic level return without actually taking any construction, development, or lease up risk.
Jack?
Yeah, I think maybe Craig, we tie this up with a bow. I think that the takeaway for me is that especially kind of juxtaposed versus our previous conversation about build to rent. This is different asset classes have different are investable at different times, and probably investable, I would say, at all times, but with different strategies. And for build to rent right now, or even single family overall, I think that what works right now is fix and flipping on deals that make sense, where you're able to buy assets at the right original cost basis, because the top line hasn't come down. And to the extent that you're a long-term holder and using leverage right now, know that you're not going to get a phenomenal cash on cash return out of your incremental rental property assets. And as long as you've got a capital base that has that in mind, that has that very long term and doesn't need the high cash on cash of today, then if you're making a long term bet on American housing, I'm down with that thesis. I think it makes sense. Whereas you can look at office and say, hey, there's some uncertainty about what 10 years from now looks like. Mitigate those 10-year horizon downside risks through high current cash on cash, and believing that you've got an asset that is going to have terminal value. And so, it's not an uninvestable asset class. It's just that you need to have a thoughtful thesis on what works today, and then a mining operation, right, to then go find what you think is congruent with that thesis. And that's, I think that's probably the takeaway for me on, how to approach different asset classes at different points in the cycle, right? It doesn't mean that you should never, you don't need to just sit on the sidelines for a particular asset class ever. You may need to pivot your approach, your screening criteria. And it seems like you guys are doing a great job of that at Sentinel on the commercial side.
I would have loved to have heard more about the mining operation, because I think that really hits people exactly where they live, mostly in this business. It will always be a business of mining, obviously.
I'll say what's interesting. I'm sure Dennis will add all the detail to it. Is that we had to really kind of sit back and refine what we thought were the assumptions we wanted to operate under in order to remine the kind of assets that we thought that our investors would invest in, our banks would lend on, and would have the kind of product that we were willing to hold, both from how much capital was invested in the product and the price per pound perspective. We had to
How early on did you guys have to redefine that?
Just last week.
Oh.
I mean, just last week, the week before, 2 weeks ago. I mean, it was either we sit back and find the needle in the haystack, or come up with a refined thesis on saying, okay, these 4 boxes, if it hits these 4 boxes or 6 boxes, then we'll buy into those boxes. And I think Dennis can talk about what we just recently have kind of refined it to, so that we can mine to those boxes.
Yeah. I would tell you, because Fred and I pay so much attention to the capital markets, we are constantly evolving what we think is a good deal. But it really wasn't until recently where we felt like, okay, we know there has been a true transition in the market that's going to be here for the next couple of years. How are we going to assess everything going forward, right? Because now we know what we didn't know before. We know there is no roller coaster in rates. We know that the distress in the commercial real estate world is probably going to be slower than what we anticipated. And so what is the best way to still play in this sandbox where we can buy assets that make sense to us today? And I think that's the most important thing for any investor. And that's where a lot of investors get, they get sideways, is they start to underwrite to tomorrow, and you have no fucking idea what's happening tomorrow any more than anybody else. So that is the biggest problem, is, does it make sense today? And so literally we were sitting in Dana Point last week going over these key elements, like, okay, yeah, we agree that the lease term should be at least X. We think the total return of capital has to be at least this. We need a spread from our cap rate to our debt of Y, and and putting all those together builds this buy box that makes it a little easier to navigate through all the fluff, all the listings, all the back channel inside deals that we're looking at. It's pretty easy to get to a quick no now, because in this environment there's still a lot of risk at play. And so the best way to avoid that is really just by creating a very tight construct that we operate within.
How much of what you're seeing is actually on the market versus you get the call from the guy who just, found out about a potential listing?
I mean, it's pretty, I would say probably 80% of what we see is on the market, or about to be on the market, because, in the commercial real estate world, it's not quite this, there's not bird dogs the way you see in the single family world quite the same way. It's like, I know a guy who owns 1 million square feet of industrial, or whatever. There's just, there's not a back channel to a $400 million asset or something the same way there is to a house in Plano. So it's a little bit of a different animal. We have a lot of direct conversations with the existing owners, and we're working on, growing our direct to owner operator channel as well, because we think there's a good runway on the sale leaseback business over the next several years as corporate debt gets more and more expensive and cash becomes king for those groups as well. But it's it'll be tough. I think we have very strong conviction in what we're doing, but ultimately the proof's in the pudding. We still have to go out and raise that capital. We have to find a lender that agrees with us and can play ball all the way to completion. And a lot of moving pieces to get a deal done in this market, period.
Well, Dennis, it has been just a genuine pleasure to speak with you. Can't thank you enough for taking the time. Really enjoyed the conversation that we had in episode 12 about build to rent. And then obviously this one has just been a real eye opener, I'm sure, for many. So thank you again for that. I hope we can have you back sometime again. I don't know what we can pay you. Probably nothing again, but you'll have the microphone and the camera ready to go.
I'm keeping the gear. Well, thanks for having me, guys. It's I talk shop with Fred every day, and I've known Jack for years, and Craig, it was great to know you. I'm glad you guys are doing this podcast for your clients and other investors out there. I think this is in this universe, all this information is available for free. So I love that you are making this as a resource available to folks right now, instead of them finding some huckster to pay $10,000 to find this kind of information.
Well, guys, I will tell you that I've received some feedback from folks that have been listening, and they're really impressed with the depth of the content. Really glad that we're doing it. So I'm thankful for just adding more to that today. Today was a real deep dive into two great topics that affect many. So thank you again. That's episode 13. Jack from Copenhagen, Fred from some undisclosed bunker, and me here at Dominion getting ready to go raid the place. So they're not here. Guys, thanks for tuning in.
Thanks, guys.
Thank you.